I remember when I started trading in the markets regularly, I think it's way back in 2015, 2016. I used to think that PE ratio is the holy grail for investing in any company. Only after some mistakes, I came to this realization that how naive I was to think that way. The common mistake that many newbies make in the market is to look at a PE, look at a low PE company and think that it's undervalued, and look at a high PE company and think that it's overvalued. How we all wish the market is so easy to predict, right? In this video, let's take a quick look at this good old indicator PE ratio and whether it is a value trap or a value buy. What kind of sectors or companies have high PE or low PE, and why PE ratio alone is not enough to fully evaluate the company's value and future stock performance. First, let's take a look at PE ratio. The price to earnings, which is also called as PE ratio, is a financial ratio that compares a company's current stock price to its per share earnings. Per share earnings is also called as EPS. The PE ratio is calculated by dividing a company's current traded price, stock price, by its EPS. EPS or earning per share is a measure of how profitable a company is. EPS indicates the company's profitability by showing how much money a business is making for each share of its stock. So the formula is simply net income, which is the money that the company is making minus any dividends that the company is paid off throughout the year, divided by the outstanding shares that the company has. If we take a simple example, say if a company is making 100 crores and has 10 crore in terms of the total number of shares that the company has, the company has distributed say about 10 crore in profits in terms of say dividend. Of course, I think 10 crore is too much for a 100 crore revenue company, but let's take that as example for the sake of it. Then the EPS comes to about 9 rupees. So remember again, there are different forms of EPS that the investors and the analysts use in the market. There could be basic EPS, weighted EPS, there could be current EPS, future EPS, etc. Let's not go into too much details of these nuances of the EPS, different kinds of EPS, but as long as the concept is understood, I think it's fine. Let's put the EPS in the PE formula. PE, as I said, is nothing but dividing the stock price with its EPS. For example, if a company stock is currently trading at 100 rupees per share and it earned 5 rupees per share in the last 12 months, then the PE ratio would be about 20, which is nothing but 100 divided by 5. So at the most basic level, a PE ratio identifies for 1 rupee of earnings what investors are willing to pay for 1 unit of stock. So if a business is say in this instance, if the business is trading at a PE ratio of 20, it indicates that the investors are willing to pay 20 rupees for every 1 rupee in earnings. It's a relative indicator, always needs to be compared with the sector peers. General notion that high PE is equal to overvalued and low PE is equal to undervalued, though it is correct to a larger extent. If one goes only by this logic, then there's most certainty that you lose a lot of opportunities and lose a lot of money as well, because a low PE company can remain low in terms of price for a very long time, and a high PE company can remain high and can keep going up for a very long time. So this logic needs to be combined with some other financial metrics. PE ratio as a standalone metric does not mean anything unless until we deep dive into understanding the revenues, the growth, the profitability of the business, and the consistency of all these metrics that we just spoke about determines how the investors value that particular company, which in this case is a PE ratio. Think of it like a jigsaw puzzle. PE ratio is just one piece in the puzzle, though it's a very important piece. Like this, there are many other factors that we need to collect to form some kind of a conviction picture in our head that we say, yes, this makes sense to put my money to work. Some of the key factors that determine the PE ratio is one of those important factor in my opinion is the cyclicality nature of the business or the defensive nature of the business. Cyclical businesses are generally those which fluctuate in conjunction with the economy. Because of this reason, they tend to attract a lower PE because their earnings are generally tend to be lower whenever there is an economic downturn. Some of the common sectors that we all may be aware of in the cyclical businesses are the likes of consumer discretionary sectors, which where you have this your automobiles, restaurants, luxury goods, and which produce non-essential goods and services. The industrials, the metals, manufacturing, transportation, aerospace, defense. The financials tend to be the first one that gets hit in any kind of an economic downturn, whether it is a public sector banks, private sector banks, the insurance companies, or the financial services companies, or the NBFCs, the likes of Bajaj Finance. And then you have your energy, which is oil and gas companies, and then materials and technology, which is IT companies. And defensive companies, as the name suggests, are someone which tend to perform relatively better during the economic downturns, as they're less affected in the changes in consumer spending and economic growth. These sectors are the ones which include companies that are essential goods and services that are having has steady demand regardless of the state of the economy. Some of the common sectors that we all know may be consumer staples, which includes the food, beverages, the household related products. There are healthcare sector, which is a pharmaceutical, medical devices, hospitals, all comes under the defensive sector. There could be utilities that can come into here, which is your electricity, gas and water, and your telecommunications. This could be another sector which can come. So these sectors tend to all the defensive sectors, defensive companies, stocks that fall under the defensive sectors. If you look at any stock in the FMCG basket, say for example, you talk about Hindustan Unilever, D-Mart, the Britannias of the world, the Daubers, and all these, Godrej, etc. All of them has high PEs when compared to the metal sector, or say the IT sector, or oil and gas names, and etc., which are mostly cyclical businesses. So these sectors and stocks tends to attract the higher PS because their earnings are less affected by the economic cycles. If there is one thing that the investors hate in the market, then it is uncertainty. If you remember in COVID times, I think February, March 2020, everyone is rushing through the exit door because there's so much of uncertainty that was prevailing at that point around the world. The result of that is the kind of waterfall decline that we have seen during that time of March 2020, right? So the market always reward predictability in earnings and profitability, and the reward is nothing but the higher P ratio. The great example is probably HDFC Bank in India, which many call as an Excel stock. It's extremely predictable in terms of their earnings, growth and profitability is concerned, which is so rare for a bank, but they managed to achieve it for years and decades, and the result is evident in their stock returns. It's grown consistently year on year. If you look at it in the last 10 years, probably one of the very few stocks which has given predictable returns for the investors. When can one consider a stock as value trap? A value trap is a stock that appears to be undervalued in terms of its PE ratio is concerned, or any other financial metrics are concerned, but is usually overvalued or has poor prospects for growth. Case in point, maybe if I take an example of oil and gas and PSU stocks, they may look dead cheap on paper in terms of their PE ratio is concerned, and also they give great dividends, almost FD rate types of dividend. But what are their growth prospects? Can they grow consistently? If the answer is no for all these things, it reflects in their stock returns as well. If you take most of the PSU stocks, maybe 90% of them, the returns that they gave for investors is very minimal, or maybe a lot of times it's negative in nature. If you look at say 3-year, 5-year returns, so that is a value trap. In my opinion, these stocks are good on and off reasonably safe trading buys for few months or maybe a year, but maybe not a good investment if you go and check their historical returns of this stock. On the other hand, a value buy is a stock that appears undervalued based on its PE ratio and other financial metrics, and has good prospects for growth. There are few that I can think of, but probably the great example here can be PSU banks, which could have been a value trap a few years ago, and when they were trading at dead cheap valuations because of the lack of trust the investors has in them, because nobody knows what scam is going to pop up tomorrow. And once they clean up all their NPAs and with the tailwind of credit growth behind them at the present, we all have seen the kind of returns they've given in the last year. I mean, that is a great example where something could have been a value trap few years ago turned into value buy now. There's no single approach to making these calls. It depends on one's risk appetite and how one perceives things in making some kind of judgment calls. That's the fun of the market, right? At the end of the day, it's an art, it's not a science. I hope this is useful, and this is Pawan. I'll see you in the next video.